Hello, I am Francesca Monti. I'm delighted to launch the Qatar Center for Global Banking and Finance new virtual seminar series. So this will be a fortnightly event, and it's intended to provide a forum to discuss and to present and discuss new research on issues related to central banking. Our first speaker is Andrea Ferrero, who is professor at the University of Oxford. He will present his joint work with Richard Harrison and Ben Nelson on house price dynamics, optimal LTV limits, and the liquidity trap. The seminar will last 1 hour, including 10 minutes discussion at the end. So please submit your questions via the Q&A box. We will either, Richard Harrison will either take them online, or we will interrupt Andrea to ask them, and then we have more time for questions at the end. So let me hand over to Andrea so he can start the seminar. Please.
All right, thank you, Francesca, very much for the introduction. The paper I'm going to present today is entitled House Price Dynamics, Optimal LTV Limits, and the Liquidity Trap. As Francesca said, is joined with Richard Harrison and Ben Nelson, and usual disclaimers apply. So the starting point for the paper is the observation that is well known to most people, that the main cause of the financial crisis of 2008 was the rapid rise in house prices. Here picture in real terms in blue between the mid-90s and 2006, and a subsequent decline that lasted for about 5-6 years thereafter. At the same time, households in the US undertook more and more mortgage debt, which here is pictured in red as a percentage of GDP. And you can see that, with some lags, the debt to GDP ratio also follows similar dynamics. So it peaks slightly later and then, decline quite significantly over the next 5 years or so. So the question that we want to ask in this paper is to which extent the introduction of new policy tools, and in particular we're going to talk about macro-prudential tools, and in particular even more specifically we're going to talk about one macro-prudential tool, can affect this type of dynamics, and hence possibly prevent the occurrence of new crisis going forward. So the discussion, the debate on macro-prudential tools became particularly intense after the crisis, and a lot of tools have actually been introduced as a consequence of the crisis, and obviously different countries have different institutional arrangements. Here we cite one survey that overview goes over the different arrangements, but broadly speaking, we can think of the new resulting policy framework as one in which monetary policy continues to set interest rates, whereas we add another dimension, which is a financial stability dimension, in which the regulator controls macro-prudential tools. And again, across countries, the institutional feature and the governance may differ slightly. So here we are more interested at an abstract level, more general level, how these different tools may actually interact. And so this is really the question of the paper: how should this monetary and macro-prudential policy conducted? And there is an interesting quote by former Governor Mark Carney in 2014 that was mentioning that as the UK economy was recovering from the crisis, he thought that the policy tools at the disposal of the Bank of England must be used in concert. And so the question for us is what exactly means to use this policy in concert, and what the effects of these instruments are. So what we do in particular is to develop a simple framework to study the interaction of monetary and macro-prudential policies. You can think of this simple framework as having the underlying New Keynesian structure with nominal rigidities in the literature, to have real effects of monetary policy, enriched with a combination of two elements. One is the presence of savers and borrowers, the latter limited by collateral constraint, as in the tradition of Kiyotaki-Moore. And the second one, an explicit role for financial intermediation, for instance, similar to the work of Cordy and Beaufort and others. We're going to pursue normative analysis, so we're really trying to answer the question how this policy should be conducted. And we're going to do this in two steps. We're going to first derive a welfare-based objective for monetary and macro-prudential policy that we're going to split in a way that will be clear later. And then we're going to simulate a house price boom-bust scenario similar, trying to reproduce the picture that I showed you at the beginning, considering different drivers of house prices, and this will have, in some dimension, important implication, allowing at the same time for occasionally binding constraints, both on the interest rates and on the collateral constraint. What I would like to stress is that in this paper, we really focus on the implications of macro-prudential policy for monetary policy. So, the interaction between the two forms of policy is potentially very far-reaching. We're going to focus on how macro-prudential policy affects or can affect monetary policy, and the main results will be that macro-prudential policy can facilitate the debt deleveraging scenario that I showed you at the beginning, and hence alleviate the zero lower bound constraint for monetary policy. Very briefly, a selected review of the literature. There are obviously, other contributions that have looked at this question from, similar or different angles. Issues of, for instance, of coordinations of the two policies. So that would be one first set of papers that we relate to. A lot of the literature has focused on capital requirements and monetary policy. So from this perspective, we're going to take a complementary angle and focus instead on loan-to-value ratios as a policy instrument, with the caveat that obviously not in every country the central bank or even the financial regulator has full control or the full power to adjust those limits. There's obviously an even broader literature, even richer literature that has looked in the context of the financial crisis to the ZLB constraint and the issue of deleveraging, and as a consequence, how macro-prudential policy can help in this context. And finally, there are a number of empirical studies that help us kind of think through both the set of instruments and the empirically measurable effects that we've seen and we are likely to see in practice. So this is the outline of the talk. I'm going to start presenting the model. I'm going to then move on to describe the optimal policy problem and then illustrate our main results in the context of boom-bust experiment. So let me stop for a second here, checking if there's any question. No? Can I move on? Okay, great. So overview of the model, we basically take a paper by Giustiniano, Primicero, and Tambalotti, which is now out in the Journal of Political Economy, that has a borrower and saver structure with collateral constraint and some financial constraint on banks or financial intermediaries, and combine it with the standard New Keynesian model, so introduce nominal rigidities in that model. We're going to also depart from some of their more restricted assumptions on preferences and technologies. But broadly speaking, at the heart of the model, there are two sets of agents, two sets of households, patient and impatient, who differ in their individual discount factor. So impatient households have a lower individual discount factor, would like to borrow, in particular, would like to borrow to purchase housing services. While on the other hand, patient households save via deposits and equity in financial intermediaries. These financial intermediaries essentially just channel these funds from the two groups, savers and borrowers, but would be subject to an additional financial friction that would make them relevant. And so they're not really just a veil as, you know, they may be in a plain vanilla New Keynesian model. So the two key financial frictions are, on the one hand, the collateral constraint on impatient households. As I said before, this will take more or less the standard form as in the Kiyotaki-Moore literature, and a capital requirement or an equity requirement, if you like, on financial intermediaries. And I'll mention the importance of this constraint in a second. So let me start from describing the problem of the borrowers. There is a continuum measured Z of borrowers who maximize the present discounted value of utility that you can see here. Beta B is the individual discount factor for these households. They have exponential utility in consumption, CES utility in housing services, and CES is utility of labor. And in particular here, I would like you to note the exponential utility of consumption, which is slightly non-standard, but it's very useful for us for aggregation purposes. And to the extent that we're going to adopt later on a linear quadratic approach to our optimal policy problem, actually the results are going to be very, very similar to adopting a more general CES specification. In the budget constraint on the right hand side, you see that borrowers derive sources of funds from labor income. So this is the first term here. They enter the period with some debt, which is DB, and on which they pay a gross interest rate RB. They also enter the period with some existing housing that has a market value Q. They receive some profits from ownership of intermediate goods firms and pay some lump sum taxes. And on the expenditure side, they consume C, which has a price P of the aggregate consumption bundle, choose the new amount of debt, and choose new purchases of housing services. And here the assumption is that the utility of housing is proportional basically to the stock, as is standard in the literature. The exact specification of the collateral constraint here actually follows Guerrieri and Jacobiello and also others in the literature, which generalize sort of the Kiyotaki-Moore formulation by allowing for some inertia. So if you set gamma D here equal to 0, then you really have the standard specification in Kiyotaki-Moore, where current debt is lower or equal than some fraction theta of the value of housing. And here we're assuming that the collateral that enters the constraint is the current value of housing. The role of gamma D is primarily quantitative and will allow us to basically decouple the dynamics of house prices from the dynamics of debt, consistently with what you've seen in the picture in the first slide, where the deleveraging cycle is slightly delayed compared to the collapse in house prices. And the other important observation is that these theta parameters will be our macro-prudential policy instrument. So when we introduce macro-prudential policy, we will allow the policymaker to set a certain value for this parameter, and hence affect the choice of borrowing by the households. The second group of households are savers. They have a similar problem, so their specification of utility is similar. The only difference they have is the discount factor, which is beta S, which is higher than the discount factor of borrowers. On the right-hand side here, you see their source of funds, which is similar. So they also obtain wage income. They have returns on their deposit, which is the S, and they have the returns on equity ownership of financial intermediaries. They also start the period with some initial housing stock, pay lump sum taxes, and receive a share of profits. On the expenditure side, they also consume, invest or save in new deposits, in new equity, pay an adjustment cost to vary this equity position, and purchase new housing services. Let me notice a couple of things about this budget constraint. So you may have noticed that we index the wage of the two groups differently. So the wage is kind of group specific. And again, this is a little trick that allows us for aggregation. It makes aggregation very simple. It should, we have a conjecture that it doesn't actually affect the result very much, and we are undertaking a significant revision of the paper where we actually relax this assumption, and at least our results do not suggest that this is central. But for this version, actually simplifies aggregation quite a lot. The other observation that I want to make is that this equity here, this asset here, perhaps this equity is a bit of a misnomer. It's really a safe asset in the sense that the return is known when the decision is made. It's just that it has a different it has actually a cost adjusting this position, which is captured by this function gamma, which, as you see at the bottom of the slide, is quadratic in deviation of the individual choice of equity to the aggregate choice that every household takes as a given. And the key part, which I'm going to show you in a second, is that it creates a capital structure on the liability side of the bank's balance sheet. So let me turn to those. Financial intermediaries have a very, very, very simple balance sheet. On the liability sides, they have deposits and equities. And on the asset side, they have loans that financial intermediaries extend to households, to borrowers. And the reason why this capital structure is relevant is because the second constraint that we have is this capital requirement of leverage constraint, which says that equity has to be bigger or equal than some fraction kappa of loans that are issued. And this is actually quite common in the literature. For instance, it's used by the literature on intermediary asset pricing, as in Hank, Krishnamurti, and others. And we assume that it's binding in equilibrium. Otherwise, the banks are not relevant in the model. We assume that banks operate in perfect competition, and so the zero profit condition basically pins down the interest rate on loans, which is a linear combination of the return on equity, which, as I mentioned before, is going to be affected by this adjustment cost, and the return on deposits, which is basically the policy rates. And the weights are a function of this K tilde, so of this capital requirement or leverage constraint. So you see that when this leverage constraint goes up, so when the equity requirement gets tightened, then the cost funding effectively for banks increases, and then this is passed on to borrowers, so the interest rate on loan increases, and vice versa. And so we're going to assume that this is exogenous, and we're going to use it as I'll show you later on, as a variable to generate one of our scenarios for the quantitative experiment. You know, we could actually, we've done some exercises in which we have treated this as a policy instrument, and this relates to sort of the literature on capital requirements. You can think of this actually as a policy instrument that affect capital requirements. Because we've decided to focus on the other macro-prudential side, then we're gonna treat this just simply as exogenous. Okay, so the rest of the model is very standard. We have a supply side which is completely, you know, new Keynesian traditions, in which there is a set of retailers who package differentiated intermediate goods with the CES technology, and intermediate goods are produced with a linear technology in labor. So basically, firms hire an aggregate of labor of the two types, which has a a Cobb-Douglas function with weights reflecting the share of the two groups in the population, and this is the corresponding wage index. And then this intermediate good producer set prices a la Calvo. And you know, I'm not writing the problem here. I'm sure everybody is familiar with that. And finally, to conclude the description of the model, we have goods market equilibrium conditions that simply says that all output produced is consumed by the two groups in proportion to their respective size, and plus the resource cost that, you know, gets basically wasted in terms of adjustment of the equity position. For the housing market, we assume that the housing is in fixed supply, so it's equal to H. So perhaps we may want to think about it as land, and that fixed supply is equal to, you know, consumption of housing of the two groups, again with the respective shares. The third equation is the aggregate balance sheet of the financial sector that says that loans are equal to deposits plus equity. And then, you know, since we are in an incomplete markets model, we need to keep track of the evolution of real private debt, here written in per capita terms. So that today is equal to interest rate payments on existing debt, plus consumptions minus output, plus you know, the evolution of housing. And the last term here is basically you know, steady state subsidy that ensures the efficiency of the steady state. So this completes the description of the model. Let me stop for a second to check in case there's any question.
Let me relay you a few questions that have come up. So a first one that I have here is the following. Is it important that profits go to both borrowers and lenders as opposed to savers' equity holders, which I understand to be bank equity?
Well, I think, you know, this is the standard assumption in the literature that the profits of intermediate good firms are not traded and are distributed across the population. I think in terms of aggregation, it's not important in the sense that you know, when you add up the two budget constraints, basically you know, it doesn't matter all that much who owns the firms, as you know, to the extent that these are non-traded profits.
Sorry, so this was a question from Riccardo Mazzolo. Then I have a question from Charles Haswell, who asks the following. So banks create new money when they lend it, and they have the ability to add the same figure to both sides on their balance sheet at the same moment. So they're not just intermediaries, he suggests. And so why do none of the models, including yours in this study, take account of this?
Well, there are models that do, right? I mean, the work by Michael Kumov does that. I think, you know, this is kind of a different questions, a different question to what we do. I mean, I don't want to enter in the discussion of that literature because that's not what we do now, and it's actually not my work. But perhaps we can leave that question for later on. I mean, in our work, what's central about the financial intermediaries, it's their is the fact that they're capital constrained. And the fact that there is this equity requirement, which essentially generates a spread between the interest rate on loans and the interest rate on deposits, which is the policy instrument. I mean, just very briefly on that literature, the consideration that the banks create money, you know, while absolutely true in an accounting sense, in general equilibrium, I think loses a little bit its potency in the sense that the policy rate still affects the marginal decision of banks. So it's not that banks will generate money at any level of interest rates. But, you know, again, let's postpone that discussion maybe for later on.
So I'm going to relay you one last question before letting you go on to the next session. So Sudipto Karmakar asks if you could please explain what you buy by having this capital requirement constraints. So what is the inefficiency that it is correcting? And is the standard pecuniary externality, is it the standard pecuniary externality correction?
Yeah, no, it's so this, as I said, this equity requirement effectively what it buys is that it creates a spread between borrowing and lending rates. So that's all, right? And the reason why we do that is because one scenario that we have later on, as you'll see in the boom-bust experiments, is a scenario in which the increase in house prices is generated by a series of expansionary credit supply shocks. And we capture these credit supply shocks by a reduction in this K tilde parameter, if I can go back one slide, by this K tilde parameter. So effectively, what we're assuming is that leverage constraints become less tight. But as I said, this will become exogenous. And so in our view, the best way to think about that is more as a market, financial market deregulation or innovation that is besides macro-prudential considerations. So that's what it buys us. It buys us this creation of spreads. There are other ways to do it, you know, and I think in reduced form are going to be probably quite similar. The pecuniary externality point, though, is there, but it's there on the collateral constraint, which is this one. But it's not. But I wouldn't say that in our case the leverage constraint corrects the pecuniary externality element. So our exercise as a much more of cyclical, so it will have a lot more of a cyclical macro-prudential flavor than you know, papers that are concerned with the pecuniary externality considerations. And you know, I'll get back to this point in a little while. Oops, going the other way. Okay, can I carry on?
Yes, please.
All right, thank you. How am I doing on time? I don't have a clock here.
You have 20 minutes.
Thanks. Okay. All right. So we wanna take a linear quadratic approximation to the problem because we think part of the value of our analysis is to make transparent what the objective of macro-prudential policy are, and how this relatively simple model departs from a standard model without this sort of heterogeneity. What I ask you to do is the thought experiment of similar economies in which, however, the discount factors are identical and there is no collateral constraint. In that economy, the efficient zero inflation, for simplicity, but I don't think that matters, symmetric steady state would imply full risk share. So we're looking for basically for a steady state in our model in which the discount factor of the savers is higher than that of the borrowers, and a steady state in which the collateral constraint is binding. We're going to look for a steady state that replicates the same allocation. And we can achieve that by using lump sum transfers and housing tax, and a housing tax on savers to obtain that full risk sharing result. So basically, we're going to use this instrument only steady state to ensure full risk sharing, so that consumption, housing, demand, and hours are equal across households. And then we use the standard production subsidy to obtain an efficient level of output. But this is, in the basically identical to the what the New Keynesian literature does. And we do this for because this way we can derive a clean second order approximation to the utility function. And capital requirements here only have second order effects on steady state output. So they don't have a steady state effect up to the first order. Okay. So in the second order approximation of the household utility that we take around this efficient steady state, we make an additional assumption, which is that it's not obvious in this economy with two different discount factor at which discount factor that the planner should basically maximize welfare. We're making the assumption that the policymaker takes a geometric average of the two individual discount factor, and this is completely arbitrary. I mean, the results quantitatively don't change if we won't use one or the other, because the two are relatively close to each other. We can solve the problem for any discount factor, but this is an assumption that we need to make. Okay, so the loss function that we attain under this set of assumption is the following, as four terms. The first is the output gap. The second is square of inflation. The third is the consumption gap, defined as the difference between the consumption of borrowers and consumption of savers. And the fourth is the housing gap, defined equivalently. So housing demand for borrowers minus housing demand for savers. So the first two terms are standard, the ones that are there in the New Keynesian literature, and are due to nominal rigidities. The next two terms are basically due to the lack of risk share. So as I told you, this is an incomplete market model where risk sharing is imperfect. In the counterparts with complete markets, these two terms, the counterparts of this model with complete markets, these two terms would disappear. So I'm gonna tell you later that basically these two terms we're gonna interpret as the additional terms, the ones that basically the macro-prudential policy maker would want to target. As I said before, the leverage constraint was assumed to be exogenous. If it were endogenous, that would add a fifth component, like it's written out here, which would capture basically the welfare cost due to resource losses due to the variability of that policy instrument. There are a bunch of special cases that you can think about with flexible prices or with fully segmented housing markets, but in the interest of time, I will skip those. Okay, so then we have a bunch of constraints on this optimal policy problem. The first is a standard Phillips curve, forward-looking Phillips curve. The second is the Savers-Euler equation, which here we rewrite in terms of the aggregate output gap. So we basically write in terms of welfare relevant target. So the aggregate output gap minus the consumption gap. Right, so you can write this in terms of consumption savers. So here we write it this way, again, just to make clear that how the welfare relevant target enter this equation. Similarly, we have a borrower-Euler equation, which we also rewrite in terms of welfare relevant targets. And here it's a little bit more convoluted because a number of additional factors enter, including the presence of these spreads. So the interest rate that the borrower faces, as I was saying before, is the policy rate plus the spread, which reflects this leverage constraints. You also see the presence of this, inertia component in the borrowing constraint coming in here. And here mu t is the Lagrange multiplier on the collateral constraint that is positive or zero depending on which state of the world you're in. The last equation in the slides is the evolution of debt, which is just rewritten in terms of welfare relevant targets. And then the second set of constraints are related to the housing market. So here we have savers housing demand. I highlighted here in red this housing demand shock, which will be the other source of the other scenario that we consider to generate our boom bust exercise. And the rest is basically relatively standard, again, with the caveat that we've written terms in welfare relevant targets. The second is the borrower's housing demand, which has a similar form, although you see the presence of the Lagrange multiplier and the collateral constraint parameter or the LTV parameter entering here in the first bit. And lastly, we have the borrowing constraint, which can be occasionally binding, has these smoothing terms, and the contemporaneous element here in square brackets. Okay, so this basically completes the description of the optimal policy problem. In the last, I guess, 10 minutes or so, I will describe the boom bust experiment, but let me stop for a second, check if there are any questions.
Go on for now. We'll take the questions all at the end.
Okay, all questions at the end. Very good. All right, so here we go with the experiment. We have calibration. You see here that we split this table in two. Basically, we take some parameters from Iacovello and Neri's estimation and some parameters from basically calibrating directly the targets from the UK economy. Not going to spend time on this. Let me tell you how we actually construct the scenarios. We actually construct two scenarios for the boom bust in house prices. The first, I'm going to call it credit supply shock. So we're picking a sequence of this kappa variable, so this leverage constraint, such that the credit spreads in our model fall by 250 basis points over 5 years, in line with the evidence in Giustiniano, Primiceri, and Tambalotti's paper called mortgage rate conundrum. So this corresponds to the fall between 2000 and 2005 in spreads, roughly speaking. And then the crisis will be an abrupt tightening of spreads, so that the nominal interest rate hits the zero lower bound in the absence of macro-prudential policy. Okay, so our baseline scenario will be absent macro-prudential policy, and then we add Macro-Pru later on to evaluate its effects. The alternative scenario that we consider is a sequence of housing demand shocks, and here, the target is that basically we pick the sequence of these housing demand shocks, since we don't have really any observable, basically to generate similar house price dynamics as in our first scenario. So the key difference really is that while credit supply shocks only impact directly borrowers, plus of course some general equilibrium effect, housing demand shocks directly impact both borrowers and savers. So there is a different distributional element in these two scenarios. Okay, we focus on a discretionary solution. We allow for occasionally binding constraints using the methodology developed by Olden and Pites, which is similar to the Ockbin tool we're hearing Iacovello. Basically is a piecewise linear approximation that takes into account the possibility that constraints do not bind next period, while being a t, do not bind at t+1, although has the limitation that does not take into account the risk that future shock may cause the constraint to bind. So it doesn't quite capture the whole nonlinear solution in the sense that it abstracts from this risk that nonlinear solution may be able to take into account. But at the same time, it's a lot more tractable. And the additional element is that we need to adapt this methodology to take into account bounds on policy instruments under optimal policy. So this little methodological contribution, and to do that we use the algorithm developed by Brandon Pouncey and Yates that basically allows us to handle these cases. Okay, so the policy configuration that we consider are basically two. One that is our baseline, in which only monetary policy is active. So we split the loss function, the welfare function that I derived before, in two bits. The first part, we call it the monetary policy loss function, and the second part, the macro-prudential policy loss function. I mean, again, this is somewhat arbitrary, but it has kind of an underlying logic in the sense that if you take the limit to which the financial frictions disappears, basically this second bit also disappears, and you're back to the kind of standard New Keynesian loss function. So really, the financial friction introduced this element, these elements, which, as I said before, capture the lack of resharing in the model, and we think are kind of natural targets for macro-prudential policy to address. So in all scenarios that I'm going to present, the monetary authority sets the nominal interest rate to minimize the first bit of the loss function, this L0 monpol. And when the macro-prudential authority can follow basically two strategies, right? So in the first is inactive, so it keeps the LTV at its steady state value, and we think of that as kind of the pre-crisis consensus. And the second scenario sets the LTV instrument to minimize this second part of the loss function. And we also make a timing assumption, kind of a Stackelberg assumption, by which the macro-prudential policymaker moves first, and so the monetary policymaker, obviously when it's active, the monetary policymaker takes that as given. For what I'm going to write, I'm going to show you in a second, is actually useful to rewrite the aggregate demand equation as the standard AD curve in a New Keynesian model, where the natural interest rate, however, is endogenous, and it's a function of these consumption gaps. And you'll see in a second, hopefully, why that's the case. So if you can please keep that in mind. So this is what happens in our scenario without macro-prudential policy. So here we only have monetary policy active, set optimally to minimize the first bit of the loss function. So we generate a scenario in which real house prices increase by about 20% over 5 years, 20 quarters, and then collapse within a few quarters, within a couple of quarters. You see that real debt follow house prices on the upside, but then the deleveraging scenario, as in the data, is much slower. It takes about 10 quarters to fully materialize. In this exercise, the leveraging shock creates a quite significant recession of about almost 6 percentage points, and some meaningful deflation. So this is quarterly inflation in the recession is about 0.7 percentage points. So if you analyze that, you get a little bit less than 3% deflation. Under optimal policy, the interest rate rises by about 150 basis points during the boom, and then it goes all the way to 0 and stays there for about 3 years. The housing gap is positive during the boom, meaning that borrowers demand proportionally more housing than savers, and then turns negative, and the consumption gap follows a similar pattern. And you see here at the end that the natural real rate follows a very, very similar profile to the consumption gap, which is not surprising given the representation in terms of natural rates for the aggregate demand equation that I showed you before. So going forward, I'm not going to show you the consumption gap anymore. I'm just going to show you the natural rate. And you see that basically what monetary policy does is to try to track the natural rate. So the natural rate increases, policy rate increases. When it falls, central bank cuts the interest rate, but because the natural rate turns negative and there is a zero lower bound, the recession becomes particularly deep. So this is the scenario created by expansionary credit shocks, as I said before, a sequence of expansionary credit shocks followed by abrupt tightening. The next one introduces macro-prudential policy in this scenario. And so basically here we allow the macro-prudential policymaker to set LTVs as to minimize the second bit of the loss function, the composition I showed you before. And so if you look at the bottom center picture, you see that in this case, what the macro-prudential authority does is to tighten LTVs significantly during the boom, going from 90% all the way to about 65. And then when the crisis hits, it basically relaxes LTV quite sharply all the way, almost to 100%. And you see that this is actually a quite significant effect on house prices. The house prices don't increase nearly as much, less than 5 percentage point, and also the crisis is, is much smaller. In fact, in this scenario, that decreases over time, and this combination is kind of optimal in the sense that completely prevents the recession. So the monetary policymaker is able to completely stabilize output and inflation, and this occurs with actually a decline in the interest rate during the boom and a slight tightening during the bust. And the reason for that is that macroprudential policy does a lot of the adjustments. So this tightening in macroprudential policy is actually so strong that it causes a decline in the consumption gap and hence a decline in the natural rate, which the monetary policy authority wants to track. The second scenario is the housing demand shock. So in this case, we basically pick a sequence of housing demand shock that tracks housing demand shock in the other scenario, in the credit supply. We start again from the case in which only monetary policy is active, and you see that for several variables, the dynamics are very similar to the other case. So here in red, I have the previous scenarios. In blue, I have the housing demand scenario. You see that in many cases, the dynamics are similar. If anything, when in this case, when we have the crisis, the recession is actually significantly deeper, but qualitatively, the two are very similar. The difference takes place when we introduce macro-prudential policy. Again, qualitatively, macro-prudential policy moves in the same direction. However, in this case, the main difference is that the natural rate actually increases during the boom. Not a lot, but just slightly, but it does increase. And so for the central bank to avoid the recession, but also avoid a boom in output and inflation during the first 20 quarters, the central banks needs to actually increase nominal interest rates by about 50 basis points over this period. How am I doing on time?
Yes, I wanted to say we're 1 minute into the questions time, so if you could kind of wrap up.
Okay, so let me okay. I have a couple of pictures that are more sort of illustrative of what will happen, you know, if the timing of the introduction of this macro-prudential policy were different. But I'm gonna skip that. I'm gonna skip those for you know, to save a little bit of time. Let me just basically conclude by summarizing the results by looking at the natural rate. So in both scenarios, you know, you've seen that countercyclical LTVs is actually very powerful and avoids the liquidity trap. So in this sense, the implication of the presence of active macro-prudential policy is very strong and actually very useful. And the main channel is that it avoids kind of the large deleveraging that occurs when house prices collapse in the absence of these policies. The difference between the two scenarios, as I said, so here just repeated through the equation, it really is going through the effect that the macro-prudential policy has on the natural rate, which in turn is a function of the consumption gap. So as I showed you before, you know, whether the crisis is, or whether the boom bust is driven by credit supply or housing demand shocks, has different effects on the consumption gap, and hence different implication for how monetary policy should be conducted during this dynamics. In particular, if credit supply shocks dominate, natural rate falls, and hence monetary policy should be accommodative. Whereas if housing demand shocks dominate, then the natural rate increases and monetary policy moves in the same direction, meaning that it's tightening when also LTV is tightening. So let me stop here. If any question raises a point about, you know, the pictures that I showed before, I can move on. Otherwise, I'm happy to take other questions now.
Thank you. So let me start by asking a question myself, and then I'll see as other questions come in. So in this paper, you're focusing on LTV limits as the macro-prudential instrument here, but there's also other macro-prudential housing instruments that have been used. You know, the loan-to-income limit in the UK, and the requirement that banks test the affordability of mortgages under, you know, a 300 basis points interest rate stress. Can your model say something about the optimal approach for restricting debt more generally, without assuming that the policymaker kind of applies this a unit coefficient on house prices in the debt limit?
So our question here, so for full disclosure, we actually started by looking at both capital requirements on the banks, through actually assuming that K tilde was actually a policy instrument, and looking at LTVs. It became clear actually that in this model, capital requirements are not a great tool because they incur direct resource costs. So they're, you know, when you're allowed to use both, they're always kind of a dominated instruments, because LTVs don't have a direct welfare cost. So that was one reason to just focus on LTV. The other reason was that the literature was a lot more developed on capital requirements. And so we thought that by focusing on LTV, we would offer a complementary view. In terms of further instruments like the ones that you are mentioning. I guess in this model directly, I guess you could introduce LTIs, for example. We haven't looked at those. I mean, the LTV is a supernatural instrument in this model because it affects directly the constraints, but you could write the LTI constraint and do a similar analysis. I don't have an answer to that question. Now, you also mentioned there are other instruments as well, and absolutely, I think the more granular you want to go in terms of instrument, the more sophisticated your model needs to be. So here, I guess the trade-off is between analyzing a wide set of instruments and the tractability of the framework. If you're willing to go fully numerical and you're less concerned about the loss function, which for us was actually important, then I think you can enrich the model and do all sorts of analysis. Whether then you want to keep these two agent borrowers and savers, you're going to go even more with even more heterogeneity. That's yet another question, but obviously it can be done. What I can tell you we've done is this dichotomy between instruments that affect credit demand, which are LTVs, versus instruments that affect credit supply, which are capital requirement, and then we have decided to focus on the former.
So let me ask you, I have quite a lot of questions actually that are coming up now. Yep. So I would like to first relay Jumana Salim's question.
Yep.
So she's saying that the Macro-Pru, from your model, Macro-Pru can act as an alternative to monetary policy for some shocks, with the two policies working together, so that you can imagine cases, but you can imagine cases where the two would work in opposite directions. And if so, when does your model tell us about or what does your model tell us about the optimal policy mix?
So I think that, the extent to which I struggle with this question is that in this model, you can never shut down monetary policy, right? While I can shut down macro-prudential policy, I cannot fully shut down monetary policy. I cannot fix the interest rates forever, right? Because otherwise I run into an indeterminacy result. So that's the extent to which that question is challenging for this set of model. What you can see, I think, from these pictures is that, I mean, I'm not sure whether this is the extent to which Jumana was asking the question, but you can see here that, for example, this is the baseline scenario with credit shocks. Monetary policy tightens by 150 basis points during the boom. When I introduce LTV, actually monetary policy cuts interest rates during the boom, again, because the effect on the natural rate goes in the opposite direction. So in this sense, there is actually an important, I think, lesson for monetary policy, which is about the nature of the shock. As I said, when then I move to the case of housing demand shocks, we obtain the opposite result, right? Again, this is the baseline without macro-prudential policy. When I introduce macro-prudential policy, and monetary policy move in the same direction, meaning that during the boom, the interest rate actually increases. So that's really the extent of the interaction between the two policies that we can capture, where the model can say something. What we cannot address is the full substitutability between the two, because, as I said, I cannot completely shut down monetary policy forever.
Thank you. So I think Golson wants to ask a question, and then I'll since she's on the I'll let her ask the question, and then we'll conclude.
Is it okay to?
Go ahead. You're actually appearing with my name, but it's Golson.
Okay. Hi, Andrea.
Hi,
I have two quick questions.
Yeah.
One is taking it further from Francesca's point about the instruments. So you have two instruments based on the two constraints. One is the LTV based on the collateral constraint, and the other is the leverage the one that's coming out of the leverage constraint. I wonder whether you may want to consider debt to income ratio, which you can easily do, because you can use the budget constraint of both the savers and the impatient, the debt to income ratios.
Sure, but then I would want to have a constraint there as well. You're saying, or just think about.
I think the budget constraint is already sufficient. You would be able to do that. One downside of it is you would like to concentrate on the housing market. It wouldn't be as explicit as the LTV for the housing market. But I think that, you know, DTIs are widely used, so it would be good.
Sure. No, you're absolutely right. Yes. I mean, as I said before, we can do that. I think that's the easiest one to do.
I think it's very straightforward. It's very straightforward to do that. The second question is kind of harder, and I think it's a hard question for all macroeconomists. So your model produces zero lower bound for about 3 years, right? So we had interest rates at and around zero lower bound now about 10 years. What you need, you know, in terms of the ingredients to simulate the post 2008, 2009 to create this huge extensive length of zero lower bound?
I mean, I think what we learn from you know, estimated models, for example, is that obviously the recession was not just about the housing market, right? Which is what we're doing here. So actually, to some extent, I was surprised that when we first got these results that we could get such a long period at the zero lower bound just with shocks. Actually, just with one shock, right? Because it's one at a time. That originated in the housing market, right? So if you remember Bernanke's quote about the importance of the housing market, in some sense, this is extremely surprising. So then what we learn from you know, estimated ESG models is that you need a host of other shocks including policy shocks, including, you know, deliberate decisions by central bank to keep the interest rate at zero for longer than the shocks, you know, the fundamental shock would predict. So that's what you need, right? You need you know, imperfection in other markets, I guess in labor markets. I guess some of the estimated models would tell you that also TFP fell. So you need I think a richer shock structure, and you also need to consider to which extent it was actually a departure from the monetary policy rule. And so you need actually expansionary monetary policy shocks to keep the interest rate at zero for longer.
Thank you. So I think we need to wrap up at this point, but thank you very much, Andrea, for the seminar. It was very interesting, and thanks to all the participants and for their you know, participation and their questions. Before I conclude, I would like to remind you that our next seminar will happen on the 15th of June at 2 p.m. and we'll have Salim Bahaj from the Bank of England presenting his new work with Ricardo Reis entitled Jumpstarting an International Currency. And so with this, I you know, thank everybody and goodbye.
Thank you. Bye. Bye. Thanks.